Again, I don't want to get into too much detail on these because each and every transaction is different. But for example, if you own a share of AT&T stock and then you get a dividend in cash, that's reportable. If you get a stock dividend, on the other hand, that may very well just increase your number of shares or number of crypto coins in this particular case, and you might just have a diluted basis. But each individual transaction is different. So I don't want to oversimplify or give a rule of thumb, because I see a lot of mistakes made when they say, no, that's not taxable. You need to talk to your professional and find out what type of a drop or what type of a fork or what type of a transaction it actually was. Because here's the other thing about digital assets that I've watched over the past few years. As soon as you establish a baseline of a transaction, some new creative entrepreneur and some new broker or some new digital asset inventor creates a new way of doing it to circumvent some other plan. So every transaction is different and every type of asset's different. And that's why it's hard to classify these as either securities or assets, because everyone's got a nuance. So most times, if you're happy, you probably have an income event and you have a taxable event. But that doesn't necessarily equate into every single transaction in the crypto arena, because everyone's different. If you're just having new shares drop because you own shares, that may not necessarily be a reportable transaction. You may just have more shares with less basis than you originally invested. But I don't want to oversimplify it and just say, nope, don't worry about that. You just now have 200 units instead of 100 units. You don't have any taxes. It's never really that simple.